Hey, in this episode of What the Tech, we'll be discussing some of the facts about self-insuring or self-funding healthcare insurance for businesses. We'll talk about the advantages and disadvantages of self-insuring compared to traditional health insurance plans and explore what types of businesses may actually benefit from taking on the risk associated with self-insuring versus relying on the insurer to hold all the chips. We'll also explore how technology and data are now making this model even more accessible and predictable. So I hope you'll join us today as we investigate this topic and what's trending in the area of self-funding and why so many businesses are jumping on board. Before I do that, though, hit that subscribe button so you never miss any of our amazing guests or episodes. Let's go. Hey, today I'm thrilled to be joined by Spencer Smith, who's the host of a popular self-funded insurance podcast, Self-Funding with Spencer. And he's also a well-known expert on stop-loss insurance. Now, his interviews are some of the most amazing things with prominent business experts spanning nearly every business sector. During our chat today, Spencer will actually share some of his insights on the value of leveraging self-funded insurance strategies to provide savings, flexibility, and transparency to businesses trying to maximize their benefits offering. We'll also talk about how technology is actually changing the landscape. So without further ado, welcome to the show, Spencer.
Excited to be here, man. Thanks for inviting me to What the Tech.
Yeah, man. This has been a exciting one for me. I mean, kind of knowing, what your background is, your, background in self-funding and now really focusing in the tech arena. It's a perfect kind of match of what I do as well. So excited to kind of hear your insights and perspectives. But one of the first things I wanted to do was kind of touch on how this interaction even happened in the first place. And it was me actually tripping over your YouTube channel about 6 or 7 months ago. And how excited I was about that, because you actually are kind of famous for your Whiteboard stop-loss insurance explainer video. And so I actually wanted to touch on that because that's really kind of how you got your start, kind of in the podcasting arena and so forth. Because, I've talked to numerous people at this point that have watched that video over and over again because of how really perfectly and simply you explain a very complicated subject. And you've done that multiple times on your your videos. And so first off, good job. And then secondly,
thanks,
actually, what made you decide to jump into doing this in the first place?
Well, and I appreciate, Troy, the compliments. Thanks, man. And it's funny how people stumble along those videos. I shot those 3 years ago now, right? And it's like I haven't touched stop loss as a subject matter specifically on Whiteboard videos in 3 years yet. Still, they keep kind of making the rounds, which is really cool to see. But the origin story of that was kind of interesting. I think you probably remember what was happening in the middle of 2020, and life changed quite a bit. And so as a salesperson with that background, I was going, well, how do I now get in front of people if all of a sudden the opportunity to get in front of people doesn't exist anymore? And this was pre-Zoom and where Riverside was a household name. Like, people weren't on virtual calls in any regularity, at least not in insurance that I was aware of. So I was kind of like, well, what is the thing if I have to all of a sudden draw attention to myself some way? And so I saw Dr. Bricker doing some of these videos. Folks, I'm sure in your audience have heard of Dr. Eric Bricker. He's this amazing content creation machine that goes to an extreme level of detail that I could never possibly replicate, but he's a genius. And so I saw him doing that in its early stages, and I thought, well, if I were to do that, it makes sense. Whiteboarding, I've taught brokers with whiteboards before. What if I just shot a stop-loss video, because that's what I'm pretty good at? And so I did it on a whim. Literally shot a video, not knowing what I was doing. I did have a tripod, used my iPhone. I threw on a jacket because I was like, well, if I was in a professional setting, maybe the jacket makes sense, right? And then I did Stop-Loss 101. What was weird about that, and I say weird in a good way, is like that trended 3 times in the top 1% of all LinkedIn videos when I loaded it. And that was the very first video I'd ever loaded to LinkedIn. So I had no idea what I was doing. And that was just that, oh, wow, I guess there's something there type moment. And so I continued that to its logical conclusion, did about 25 videos, and exhausted everything I knew. And like you said, kind of got known for it oddly speaking, in the insurance industry as the stop loss guy, which was pretty fun.
And it worked. It stuck.
It stuck. Whether I like
Yeah.
it or not, like I can't really shake it anymore. It's funny, I haven't really directly sold stop loss in almost 4 years now. So like part of me retroactively is like going like imposter syndrome, but it's like, no, well at that time you were a stop loss expert, and I still pull the subject matter out on occasion. But yeah, it's weird being known for that thing when I haven't really sold that thing in a while.
Yeah, you've just evolved. I mean, everything about what you're doing today includes that. It's just so much more. And I do think that it's interesting because, you know, the way that we had to learn to communicate with people changed so much in such a short amount of time, because insurance was always done face to face, and it was typically done with a lot of binders and a lot of presentations and a lot of paper, right? So we've moved so far just in the last 3 or 4 years in the way things are done, whether, you know, first meetings are done virtually a lot of times, you know, maybe you do meet in person a lot of times, but, you know, it's just opened up the gates of opportunity for people like yourself, you know, who are an expert, you know, in a very specific subject, to talk about things in a very unique way and reach a very large audience instead of having to do it one-on-one, you know, one after the other.
Well, so, you know, Andy Neary, if some of your folks probably on the audience as well know who he is, you know, he's a coach for advisors like yourself. He uses the term exponential awareness, and I kind of learned some of the content modeling around Andy's playbook. But exponential awareness, I think, is a great way to put it. It's like, let's say you and I had a meeting, Troy, and, you know, you and I talked one-on-one about stop loss for an hour. I have now educated you as a potential audience member, one person for 1 hour. What if I made that same video and broke it apart and 5,000 people saw it or 10,000 people saw it? That's exponential awareness in a nutshell, is that one piece of content starts marketing for you in perpetuity.
Yeah, that's a great point. And, you know, it's a hard grind, though. I mean, you congratulated me for kind of hitting the 20 mark for episodes, which, you know, has been a grind. Yeah. It's a grind, right?
Yeah.
And I saw there's like 200 plus videos on your channel now. I mean, you've put a lot of effort and energy on it. I would like you to just touch real quickly on, you know, what 3 years later, what does that kind of produce for you from a fruit standpoint?
Well, so the most obvious thing is it's actually turned into a business. And not so much the YouTube, you know, revenue. Yeah, I'm monetized, but it's like $25 a month. It's nothing to write home about. But through kind of the podcast itself, where that more sort of morphed into a little bit more intentional, a little higher production value, quality people coming on the show with their networks and things, expanding my own, like it turned into a business where there's sponsorship dollars and where there's actual expense related to producing it and marketing it. And so just I would say making it a pro, like becoming a pro, if you will, in the podcast arena, that's been the most obvious thing that's different. And then the result of that, especially at like Plansight, if my audience is kind of a lot of insurance brokers, so is yours, knowing that my software ultimately is positioned to insurance brokers as potential buyers, like I'm almost talking to that audience eventually and attracting them through the medium of podcasting because I'm giving them value. Eventually they come and say, hey, Spencer, I checked out your website. That looks pretty cool. Could we do a demo? And so there's a lead generation mechanism that's not intentional, but is obviously there.
Right. But it's not unintentional. Let's be honest.
Let's say it's 10% intentional. But, you know, it's
that's
like
right. Okay.
that 10% is that way my employer still goes, okay, Spencer, you can dedicate time every week to do this, and we're not going to like slap your hand, you know, as a result, because they see the fruits of that effort as well, and it does obviously benefit them too.
Yeah, 100%. Well, let's talk a bit about this for a second, because I'm a technology lover, right? I love tech. Yeah. I've been in tech for the last 15 plus years, especially specifically around HR tech, benefit tech, and so forth. You know, I've taken that deep dive into the, well, let's just say the deep end of the pool with now being a broker on the other side. But let's talk about what Plansight is specifically doing and how you're kind of bringing and marrying the two industries, an industry that traditionally has not been very tech savvy, right? And you're bringing a lot of really cool new tools to the industry, and what that means for your clients.
Well, so I will describe Plansight in reference to the problem that it solves. And this is kind of a known problem. It's been a long-standing problem in our industry. Every insurance broker, and I'm preaching to the choir a lot with your audience, but every insurance broker, of course, is when they have to go market their clients' insurance lines every single year, It's a run around the fishbowl, as they say, where they're collecting data, putting it together in an email, sending it out to a bunch of carriers, waiting on proposals to come back, transcribing those proposals from PDF to Excel, and then ultimately turning those negotiations into client-facing deliverable in Excel. So that entire process that I just described is a process that could be done 25 years ago, and it's done almost identically, to what I just described. So knowing that, and knowing that every single insurance consultant in the world is doing that process to some degree on behalf of their clients, we're solving for that exact process itself. So we built software at Plansight that takes everything I just described, digitally transforms it into a platform, manage that entire life cycle of an RFP, automates it, a lot of efficiency, carriers get brought into the fold, there's some transparency, and then ultimately we're building a client-facing deliverable that's beautiful, that's custom branded to that agency, and it matches the standards that they have in terms of quality as well. And guess what? We do it without the use of Excel at all in the equation, and I think a lot of people, just by nature of me saying that, would probably be interested in learning more.
Well, I'm a fan of Excel for a lot of reasons. I mean, there's definitely a purpose for it, but when it comes to insurance, it's a nightmare, to be honest with you. Like it's like the worst tool to get stuck in when you really think about how insurance changes as quickly as it changes. The tables always having to change and having to maybe update spreadsheets or other things. It's just not the way to do it. And you'd think with software as a service, moving so far as it has, that there would be to be honest with you, more adoption than there has been with tools like yours. So I can tell you, wholeheartedly coming from the tech industry, I love what you're doing. And so, thanks, I also believe that there's a lot of people out there that, might just be holding on until they retire for a few years. I mean, the average age of the broker is in the mid-60s, right? So there's a lot of opportunity for, a younger generation to come in and, take advantage of technology like what you're doing right now. And we're seeing that, of course, here at USI. We're actually investing a lot in new talent to come into the industry and so forth. So I'm excited about that, because with that will come a wave of change, and products like yours are going to be at the forefront. You
said two things that I think are interesting, Troy. One, I am an Excel lover myself. Pre-Plansight, even being a salesperson, I was building crazy dashboards, and I loved every second of my life in Excel. What it actually is, the deficiency of Excel in that process itself, though, is it was never designed to be an actual presentation tool. So we have co-opted Excel, yes, to do all these cool things, and it's infinitely malleable, so you can design whatever you want and make it do whatever you want. But repurposing it and turning it into a presentation tool, I think, is where the obvious deficiency lies. And so taking all the good that Excel did and introduce, and some of the flexibility and the cosmetic capabilities to alter the layout, but doing it in a way that you don't have to worry about formula errors or absolute reference. I forgot to throw the little money sign in front of my A, and all of a sudden I broke the formula, a cascading effect. And even silly things like stretch logos, man. Like, so let's say you want to put, I won't name their names, but the Buca's logos on your tabs, right? You go from tab to tab, the scaling might be different. So you go try to print that, all of a sudden you got a stretched or a blurry logo, and it's all, it's on, I think brain damage is one of our co-founders called it, trying to make that into a presentation tool. So that's the first thing I would comment on what you said. The second thing, which I think is also, I would agree with you, is that there's a generational element to this. Because it's been done the same way for 2 decades, 3 decades at some agencies, it's really just they've trapped themselves into a way of doing things, and it has worked. Even if it's not a great way to do it, it has worked, and so they're stuck in that mindset. So we become almost like agents of behavioral change, trying to convince folks that there's a better way, but you're going to have to let go of some entrenched processes to get to the next level that you want to get to.
Yeah, that's an excellent point. And it actually reminds me of a conversation that I had with Michael Farber at the ROI shop, where he was talking about an ROI that he had built for his clients way back in the day, and he had built it in Excel, and how his first meeting, he was laughed out of the room when he presented this. And it was pretty powerful, an Excel document that did ROI for people. That immediately sent him back to the person who helped him build it to build a SaaS-based product that was simpler and easier to use, right? That didn't have the same complications you just laid out with Excel, because I built very complicated. You've got more of an actuarial background than I do, but I've built some pretty intense, Excel documents over the years, and they're hard to keep up with. When you're talking about, yes, you may be using them every single day, but things change at such a frequent rate. If you're not an expert in it, it becomes very challenging to keep up with that, and that's why tools like yours, with the right back end, makes sense.
Well, not only is it challenging to keep up with, but it's like passing that on to somebody else, right? Like, let's say Troy built a spreadsheet and it's 10 years old and you've mastered that spreadsheet and it's so dynamic and you love it. And then you go, well, what happens if Troy leaves, or Troy gets a new job, or Troy retires? How do we pass down his knowledge and the ability to manage that to somebody else and show them how it was built? So then you become like a bottleneck eventually for an agency as well, if that's the case. And so we see it all the time. We're obviously offering what we think is a superior way, but ultimately that's up to them to decide. But I do think there's so much tailwind behind us right now, because the industry is now looking at what we're doing and some of our competitors and going, well, obviously this makes sense. Obviously we have to react to market force changes. And so whether or not it's us or one of our competitors, we're not really getting poo-pooed anymore in terms of the idea not being viable. It's just whether or not we're the right fit for that particular agency.
Well, let me ask this. So, how does one jump from the self-funded arena? Not that it's a big jump, because you're still in healthcare, but how does one jump from that to the technology industry the way that you did? Was that just, did it feel natural to you?
Yes and no. Obviously I'm not doing any coding myself. So if that was part of the job description, I would have not have been a fit. But I think it's like taking what we understand in the benefits world, laying out what needs to be done, and then handing that off to the skilled folks to actually code that and turn it into what you see on screen. So I discovered that I don't have to be technically proficient, but what I have to do is be a liaison between what our customers are asking for, what our developers ultimately are going to deliver, and be able to communicate the bridge between those two things. And so you just start to get better at like articulating the language. I did the same thing when I was a stop loss rep. I could go to my underwriters and I wanted to speak underwriter, because if I spoke underwriter and then I could articulate why I needed some discretion or why we needed to do this or pull this lever, if I could convince them by speaking their language, then I could go back to my prospect or my broker and say, hey, guess what? I was able to do it and this is how we did it. So I discovered that being that liaison was effective in a sales capacity. So I did the same thing with Plansight. They never expected me to code, and so again, if that was the case, I wouldn't have been here. It's just knowing the benefits world and being able to communicate that to the broker or to the coders.
All right, man. So I really want to dig into this, the arena of self-funded, and spend at least the duration of the time that we have left together, kind of really diving into that. So for
Sure.
you, what are some of the main advantages when you're talking self-funded, or have in the past with organizations? Like, what are some of the things that you're really pointing to when you're talking about those things? And I have some ideas of where you'll go, but I'd love to hear your perspective.
Well, so I will actually bypass the most obvious low-hanging fruit, which is I want to save money. Everybody talks about like we can save money, and I think that is a given, that's the understanding of why you do it. So let's skip over that if that's a known quantity. The things that I like are data collection. So the ability, when we say data, that could mean anything, but the ability to actually get your own data, meaning claims, what's driving said claims, identifying the problems, and then go solving those specific problems. If you don't have access to your own claims data, you cannot manage those things. You cannot measure those things. And so until you get that hood opened up, which is the access to the data through third-party administrator reports, ASO reports, your own data analytics, until you have access to that, the strategy can't really unfold. You need that as kind of a precursor to go then save the money that you're trying to save. The other element that's really crucial, I think, is control. So Troy, like if I'm fully insured today, and let's say I've got a blues plan, and I'm a broker going on behalf of my employer and saying, hey, I'm going to shop your renewal and I'm going to get you the best deal. Well, what happens when you get a 20% renewal and you can't really describe why you got a 20% renewal? And all you really have to do instead is go, well, I'll go shop it over at UHC, or I'll go shop it over at Aetna, and maybe I'll get a good deal. But guess what? You have to make a wholesale change, network change, potential disruption, and you're not really solving a problem. You're just hopping back and forth. Or even worse, you're stripping benefits out of your healthcare plan, reducing the quality of those benefits for your employees just as a way to offset some of the financial increases. So by coming over into the world, the light, as I would say, in self-funding, now I'm going to have control. So let's say I had a TPA that I was unhappy with. Well, I don't have to make a wholesale change for the whole plan. Maybe I just swap out that TPA. Or maybe my stop loss vendor hit me with a really big renewal, but I don't think it's appropriate. I'll go shop the stop loss and swap in the stop loss. By unpacking a lot of those things that often get bundled together, you have a lot more control over vendor selection, coordination of those vendors, and it gets, again, outcomes.
Yeah, so I mean, for a lot of people, the obvious reason you would do that would be for cost savings purposes, but there's so much more to it, like as you were talking about it, because if outcomes, cost aside, are the goal, then that would mean that you could have better healthcare outcomes because you have more transparency in maybe the drugs that your employees are using and their access to not only quality drugs but quality, I guess therapies. It could be cost-effective, drugs. Mm-hmm. Like maybe you can get those even less expensive if you're managing that versus allowing, say, one of the bukas to manage it for you through one of their PBMs. And so, so talk to me about, in your experience, and again, I don't necessarily want to focus a lot of time on cost, but, when you're looking at kind of potentially looking back and then looking forward, when do you feel is like a good time for an organization to start investigating the idea of self-funding?
Well, I would used to say, once you cross a certain threshold of size, right, that's typically when most people feel, oh, we're big enough now, maybe we call it 100 lives or 150 lives to start exploring it. But I would used to say that. Now, I mean, there's solutions out there that are viable for 10 to 15 life groups, so I would say it's literally never too early to start exploring this. Now, if you're a 3-man startup, right, like we're probably talking about a different timeline. But if you have a decent level of stability in your industry, you guys are cash flow positive, you think you have some risk tolerance itself, whether you're 20 lives or 5,000 lives, doesn't really matter anymore because there is a vehicle in which you could transfer that risk over and be self-funding. So, I would say don't not explore it because the worst case is you get an idea of what could be, what's possible over the course of time, and you start iterating yourself towards that goal.
And so I'm curious when because people hear self-insured or self-funded, they think risk, right? That's like the first thing that comes into their mind. Okay, there's a reason I have insurance. So maybe talk about some of the mechanisms, and you're very familiar with them, that you've leveraged to eliminate some of that risk, because there is inherent risk in it, like typically a little bit more, but there's more reward as well. And then what are those risks that are associated with it?
Well, so what I would say is let's start with maybe getting rid of a misconception. The overwhelming majority of employers are not self-funded. Technically speaking, they are partially self-funded. Nobody ever says partially because it's a long word and they feel it's unnecessary, but partially self-funded is what 90 to 95% of these employers out there that are self-funded, they are partially self-funded, and what that means is they are buying stop-loss insurance. That's the only difference. If I was truly self-funded as a jumbo employer, I just have not bought stop-loss insurance, so I'd have nothing to manage those catastrophic level claims that we might be hit with. So partially self-funded, which applies to probably the majority of people listening to this, is I'm buying stop-loss insurance as a way to mitigate my set of downside risk or the worst case scenario type risk. Troy, does it make sense to actually explain that further? Do you want me to go into like the components of stop loss? I don't care. I don't know how technical you want to get. Okay. So stop loss insurance typically has two components. You have your specific stop loss, which is kind of that one-off, random, unpredictable, catastrophic claim. Call it a transplant or a preemie baby or something like that. That is for worst case scenario, somebody blows up the plan. We've got something that protects against that. And so as an example, I as an employer might buy a $100,000 deductible, meaning anybody that goes over $100,000 in claims, call it $2 million in claims, I only fund that first $100,000 as an employer. Then the rest is picked up by my stop loss insurance carrier. So that is your insurance. That is there for the majority of people who are self-funded. The other component of that, which is a smaller component, is your aggregate insurance, which is essentially all of the dollars that your plan spends throughout the course of the year, pooled together. If they go over a certain level, then you would be reimbursed for that as well. And probably too technical for the conversation today. But you have a risk mitigating tool in stop loss. And again, the majority of self-funded employers buy that so that they can manage the worst case scenario any given
Excellent.
plan.
Thank you so much for kind of diving into that. I do think, there's a veil of misunderstanding when it comes to self-insurance, because it's never truly self-insurance, because there's always, reinsurance and laser insurance, and there's all these different ways that you can mitigate those potential exposures. But I do think it's challenging for people to wrap their minds around everything. Just understand that there's typically a process of stair-stepping into the right, model for you at the right time, if that makes sense. I would love for you to maybe touch on what some of those different models are. Like you mentioned, hey, for a 15-employee company, it's probably not going to make sense for them to jump in the deep end, as we talked about earlier, but maybe level funding or something like that. So maybe talk about some of the different models.
Yeah, you're spot on. A level funding is really somewhat of a hybrid version of self-funding, in that it's going to give typically smaller end of the spectrum employers a guaranteed sort of cap of their risk every single month, whether you're just paying a level premium. That's where the notion of level funding comes in. You're literally just paying the same amount each month. You're paying to your maximum liability, and therefore if something's left over in terms of your actual exposure and your claims dollars, you'll get perhaps a surplus reimbursement where some money comes back. It's really the stair step into self-funding. I typically view that type of product, a level funded product, as the gateway in, and then eventually you're going to off ramp from there and go into more of a traditional partially self-funded, assuming you grow at a certain clip, assuming that's part of your roadmap. There's nothing wrong with being level funded for 10 years, but you're probably leaving money on the table if you do that. There's another vehicle that I'm a pretty big fan of, which is the group captive or a captive insurance, which is similar in nature with going self-funded, but you're instead pooling yourself with either like-minded employers, similar size employers, sometimes even in the same industry, and you're saying, hey, we're all going to band together in this group captive cell. Now we're going to be part of a bigger pool that gets underwritten, and we have a little bit more stability and a little bit more protection. Folks like True Captive Insurance, a sponsor of my podcast. Pareto Health out there is one of the biggest, or I think they are the biggest in the country. So there's ways that you can, based on your own risk tolerance and your own cash flow stability and things like that, find a mechanism to get you off the fully insured merry-go-round. So at least you have an off-ramp to start now strategizing and taking back control. And so I like all of those. There's carrier level funded products. There's independent vendors that have packaged together level funded solutions. And then there's captive solutions and things like that. There's a number of options out there that didn't really exist 10 to 15 years ago.
Yeah. And honestly, we're seeing new things pop up every single day that give you, more access to make better decisions. So let me ask, a lot of people will ask about tax implications when it comes to being self-funded. What does that mean? Like, when you're fully insured, are there different taxes than when you're self-insured? Touch on that for a moment.
Yeah, so with the obvious caveat, I am not an accountant, nor am I a tax accountant. But the biggest difference is, right, when we're paying premium on our insurance premium and we're fully insured, we're paying premium on the entirety of that premium. When you go self-funded, the stop-loss insurance is actually going to be a much smaller component of your overall healthcare costs, right? So, I'm going to throw out a random number. Let's say it's 25% of your overall healthcare spend, because you've peeled back that layer and set aside that insurance alone to do that one thing. You're only now going to be paying taxes on that one component rather than the entirety of the plan. So that might go from $1 million to $200,000 or $100,000 as an example. And so you're paying a little bit less in taxes. I wouldn't necessarily say that is the primary motivator, but it is a thing, and it could save you 2, 4, 5% sometimes on your tax liability because of that.
Yeah, so it's not a big number, but who doesn't like to just save on taxes? I don't want to send it, to the tax.
I don't think anybody loves the idea of paying more in taxes. I think more folks would prefer to pay less, right? And it's not evasion, right? We're not doing anything illegal. It's simply following the rules and benefiting from the rules that are set forth.
Absolutely. Couple more questions around self-funding that I wanted to jump into. And then I actually wanted to bring it home with a question that might be a little bit more personal to you. Okay. But, what do you feel like, when an employer is investigating this, what do you think are maybe a couple of things that you'd say, okay, maybe your broker hasn't brought this up to you, right? Maybe they haven't talked about it, but what are some questions you should be asking? What are some things you should be thinking about? And maybe if your broker hasn't brought it up to you, should you be, potentially looking at somebody that this is really something that they do?
Well, if anything I've said over the course of the half hour has resonated with, if an employer was listening, I'd say absolutely, you already know the answer to that question, is it should be being brought up to you right now. One of the struggles, I think, with employers is like understanding what my consultant is actually doing on my behalf behind the scenes, right? And I think a lot of them may not even understand how their consultants are being paid, which is a big issue. Because most of them are paid through the form of commissions by the actual insurance carriers themselves. And sometimes there's overrides and bonuses, additional compensation in there. And so if you start to realize that, then you start to question, well, who are they really even working for? And do they have any actual incentives to reduce the cost of my healthcare if their payment is now tied to my insurance premiums actually going up? It's actually a good thing for them financially for that to be the case. So if you start at least even having that epiphany and then realize, hey, not only could that potentially be a conflict, but maybe I know that we've been getting these big renewals every year, but my broker has never once broached the subject of some alternative funding models. Why is that? And if so, should I ask them, or should I possibly, and I'm not saying this is the case because I realize that's a sensitive thing, but like, should I be looking elsewhere for my consulting advice? And I think there is a threshold where you're probably in the 50 to 100 range, 100 life range, where if somebody has at least said, hey, by the way, would you consider listening to this alternative funding model? Where if that's not happening for you as an employer, then again, I would start getting curious as to why.
Yeah, I just think, being curious about it will lead you to whether this is a good decision for you or not. And let's be honest, there are situations, even with accounts that are, say, like what you would say is prime size for, potentially evaluating self-insurance, that now may not be the time. There could be, specific, claims and other things. It could be, poor population. It could be low participation. Yeah. There could be a lot of reasons why you might not want to consider self-insurance.
100%. Yeah.
You would definitely want to be having the conversation, depending, or at least had the conversation at some point to investigate the viability of that, right?
Well, because you wouldn't know, right? If you don't have that investigation, then you don't even necessarily even know any of those things are happening, right? So there are absolutely instances and real world instances I can point to where employers investigated the possibility of this, discovered there's no way in heck, right, anybody's going to take on our risk, so we're probably better off staying fully insured, and so be it, right? If that is the conclusion you come to, at least now you know why you're still using that as a risk management vehicle.
Yeah, excellent. So what advice would you give to people who are kind of just on the fence about exploring it? Because I do think people, one way or another, they've got, it feels this way about insurance anyways. They kind of feel like, hey, I'm kind of like, it's not as bad as everybody else, or if Rome's not burning, like don't shake or rock the boat. So what are your thoughts around that?
Well, so what I will say is, like, one of the things that we run the risk in our industry is that there are kind of evangelists for some of the most extreme forms of self-funding, where you listen to them and as soon as you listen to them, you would think, hey, if I'm not doing everything that person, espouses the virtues of, I'm doing it all wrong. And quite frankly, that's a disservice, I think, to employers, because then they suggest the bleeding edge of what is possible with self-funding is appropriate for everybody too. And so I do see that happening some in pockets of our industry where there's cohorts of people that only talk about this wild and radical stuff. And I don't think it's radical when you really put it together properly, but those ideas would probably seem radical to the majority of employers. And so they're not talking about the fact that there is a middle ground between those ends of the spectrum. And there's also a process to get there. And so if you're feeling like, oh, I'm hearing about all these amazing things, reference-based pricing and direct contracting and alternative specialty med sourcing and all these things that are really cool, but if you're hearing those and going, well, if I'm not doing that, I'm doing something wrong, I can assure you that there's going to be a couple-year iteration to get there. And so don't look at yourself and feel guilty, but make sure that you are thinking about how to stair-step your way to that, if that's something you think is actually appropriate.
It's a great point. Usually the first version of something is not the best version of that something, right?
Well, I use our co-founder uses a pretty funny analogy. His name's Dave Siderud. He's got all these funny isms, right? They're Dave-isms to us. But he said, the first pancake is always the ugliest. So if grandma's making you pancakes, you poured it in the pan that's not exactly hot yet, and it didn't form right, and it's a little bit clunky. There's always the first pancake that's a little bit of struggle, but guess what? Pancake 2 is a little bit better. Pancake 3 is even better. And then you hit your stride. So let's assume that's probably going to be your experience in year 1 in self-funded. There's going to be a hiccup or two. There's going to be a challenge. There's going to be something that was unforeseen. That's where somebody like you, Troy, comes in and goes, hey, I know this might happen. I'm going to prepare you for it, and then I'm also going to solve it for you when it does happen. So let's not expect it to be perfect. And as long as that's not the standard, we'll get you close over the course of time. But give us some grace, take a leap of faith, but trust us as well to be able to do this appropriately.
I'm curious. So, and I didn't actually plan on asking you this, but it kind of took me to this thought. Like, how important is it for somebody to really investigate or dig into the data before moving in to a self-funded relationship, even if it's level funded? Maybe level funded is not a perfect scenario because it's kind of fully insured with better reporting. Let's be honest with it.
Yeah, I mean that's a great way to put it. But guess what? Better reporting leads to the next phase of it, right? So like it's not even. It sounds funny to dismiss it, but it's an element that's vital. The answer to your question is if you can get the data in the first place, it is crucial. But there are instances where you cannot get the data. There are certain states that don't require those fully insured carriers to disclose that information under certain size segments. So what do you do in the absence of data? Well, there's underwriting tools that are out there now that are using censuses and AI and all sorts of social determinants of health and publicly available claims data. That's a little bit like, hey, do we want this? Is this a good thing? But what it's solving for is a problem in the market, which is there's a lot of times where you can't get the data at all. And so you have no idea if it's viable or not. And so you can't go to a stop loss carrier and get quotes or get them to protect your risk if they have no idea what the risk is in the first place. So it is crucial, but there is an impediment to that, and that is some regulatory problems that don't force those insurance carriers to provide claims data for certain folks.
Do you think, I mean, this is just a philosophical question. Do you think that they should? Do you think they should have to be forced to give that data, no matter the size?
I'm not even going to be totally diplomatic. I mean, there's a part of me wants to be, but honestly, yes. I don't really see in this day and age where there's an argument to where that data should not be disclosed, right? Like, why would somebody that's acting on your behalf, that's insuring your risk, that's tabulating your risk, that's adjudicating your claims, why would they not be obligated to give you your own data? And so the only arguments are competitive moats. The only arguments are, having opaque contracts that benefit that third party and not anybody else in the equation. So I think the more that we talk about it and the more that we expose it, the less they're going to have a leg to stand on to fight against that disclosure. And then the CAA is doing a good job of transparency and disclosure of claims and price shopping, and people are getting pretty smart about, helping members shop for care and cash-based equivalents. So I think it's a matter of time, Troy, before that's no longer an issue. At least I hope. Let's put hope out there as well. I hope that's the case.
Well, that's near and dear to my heart. I am all about transparency, and so I wholeheartedly agree with the way that you've framed that. And thank you. I mean, this has been really great, and I think that my listeners are going to get a lot of this. I did want to kind of bring it home with something that I learned about you in watching one of your videos that I thought, probably made you a little bit the way you are. And so you told a story on your YouTube about your dad. And it kind of, I thought it was a great story where you shared a little bit about a situation that put him in kind of like a no-win situation that actually turned out really good. And so I was hoping you'd share that. And what kind of impact did that have on your life?
So you're talking about perhaps the story of him having a heart attack? Is that the story, or was there another story?
No. It was the one about him losing his job.
Oh yeah. Okay. Great. I couldn't remember, man. It's always, you're always like, oh man, what story did I tell and when did I tell it and what did I say? Like, oh my God. But no, so I appreciate you bringing that up, and I never would shy away from the ability to tell a story about my dad. But so he's still with us. I'm not talking retrospectively, but my father got laid off from a job in his early 30s. I was the only child at the time, and my mom was still alive at the time. And so he wanted to take his child and his wife to like I think it was like the Mayfair or something. It was something like some, festival. And he'd planned for it, he'd asked off for it and all that stuff. And then the last day, his employer, he was doing estimation for an engineering company. His employer was like, no, you can't go. We need you. And he's like, well, I asked for it. And I'm going to take my family to what I told him I'd take him. And they said, well, if you do that on Monday, don't plan on showing up. You won't have a job. And so it was crazy. But my dad, being a little stubborn, but also very protective of his family, was like, well, you know what, and didn't show up on Monday and took his family to that festival. And ultimately, that forced him or compelled him to have to go build a business because now he didn't have an income. And there's a lot more to that story than there, but it was the catalyst that he needed to go be an entrepreneur because he was forced to do it. And then 30 years later, he built a pretty big construction company and was able to successfully sell it and exit. And it's like, if that thing hadn't happened, would he be who he is? And, would I have had the precedent or the example set? Probably not. And so, not only building a business, but protecting his family and doing what's right for his family, that was something that will stick with me forever.
Well, that was definitely out of style for when he did it. Like there was nothing back then that really protected you from losing your jobs like there is today.
Oh, yeah.
And so that I would argue that was kind of a pioneer move. Like I'm gonna do the right thing, and I'm not gonna I'm not gonna say sorry for it. And the right thing for him was putting his family first, because. Don't we all want to do that, right? But a lot of times there's this pressure. And I do think in many cases, work is changing enough that we do have that freedom to have a little work-life balance. I certainly, when I got into my career, that was not the case, right? And we're about the same age, so I think it was
oh, man, my first job, I had to wear a tie at my desk, and, I had to, if I got up, I had to throw on a jacket. You had bathroom breaks that were scheduled. I mean, like we've come a long way in the 15 years that I've been in the workforce for sure, but I couldn't imagine that was the late 80s, I think, for him then. Like, it was a bold move. It worked out, but it was definitely a bold move.
Yeah. Well, fortune favors the bold, right?
Yeah, totally, man. Yeah.
Well, I want to thank you for coming on the show with me today. You've been an amazing guest. I always like to ask, where could, people find you, harass you, listen to you? Like, give them the addresses, my man.
So the best place to harass me is on LinkedIn because I'm usually have that tab open just because it's a great way to communicate in real time with anybody effectively. I do have SpencerHarlansmith.com, which is my own domain where I the updated YouTube videos are going to be there. But ultimately, there's two places that are best to find me. On YouTube, Self-Funded with Spencer. That's my channel. You'll find all my videos, stop loss, the podcast, etc. Self-Funded with Spencer on either Spotify and Apple. Also, those go through something called Anchor as a distribution channel. But if you just Google or literally type in Google, Self-Funded with Spencer, your preferred way to interact with me will pop up. So hopefully, I compelled one or two of your listeners to do that, man, and I appreciate the chance to chat.
Yeah, man. Thanks for coming on here. I want to say thank you to the listeners who made it all the way to the end here. Thanks for subscribing and listening to What the Tech. We'll see you next week.